Hello, everybody. Welcome to another video by Orhan Aktan. And this one we'll be talking about building a personal financial strategy. So let's start. What is a portfolio? Well, portfolio is just not just collection of assets. It is a structured allocation of capital. It is designed to achieve a specific goal. The goal could be growth, income, of stability. And every decision inside your portfolio should connect back to the goal. So, before anything else, you need clarity. Before you start trading, you need to define your return requirement, your time horizon, your liquidity needs, and each of these changes your entire strategy. For example, if you need money in 1 year, your approach will be very different compared to a 20-year horizon. So, strategy starts before investing, and your portfolio is your optimization. Portfolio structure construction is optimization problem. You're balancing two things, the risk and return, but you're not free to choose anything. You have constraints, time, liquidity, risk limits. So the goal is not maximum return. The goal is the best return for your specific situation. And risk tolerance versus capacity. Risk tolerance is psychological. How much volatility you can handle emotionally. Risk capacity is financial, how much loss you can actually absorb. And these two are not always aligned. And there's also the mismatch risk, which is when you take too much risk, you might be forced to sell during a downturn. That is the worst possible time. If you take too little risk, you might never reach your financial goals. So the balance is everything. Your strategy must match both your psychology and your financial reality. And we have assets allocation, which determines most of your long term results. In the slide, we see three main components: equities for growth, fixed income for stability and income, cash for liquidity. Each plays a different role, and the way you combine them defines your entire strategy. And we have the strategic versus tactical. Now, let's look at how you manage that allocation. Strategic allocation is long term, it stays relatively stable. Tactical allocation is short term, you adjust based on conditions. But here's a risk. Too much tactical adjustment introduces timing risk, and you start reacting instead of following a plan. And that usually leads to worse results. And we have the total portfolio risk, where the risk is not about one asset, it's about the whole portfolio. In the slide, we can see the three components: the concentration, the correlation, and the leverage. You could have safe assets individually, but combined incorrectly, they create high risks. So always evaluate the total exposure. And we also have the correlation, which you can see in the slide, how assets move together, how they're attached and correlated. If the assets are positively correlated, they move in the same direction. But if they are negatively correlated, they move opposite. And this matters a lot because combining low correlation assets reduces overall volatility. And this is one of the key tools in portfolio construction. We also have the rebalancing, where your where how your portfolio changes over time. Some assets grow faster than others, and that shifts your allocation. This is where rebalancing comes in. You sell what has grown too much, and you buy what has fallen below target. And this does two things: it keeps your risk stable, and it enforces discipline. You're no longer reacting emotionally, you're following a system. We also have the return structure, which, as you can see, the three components: the asset allocation, compounding, and reinvestment. And here's the key insight: most of your long term return comes from structure, not from picking perfect investments. Consistency matters more than timing. Risk adjusted thinking. Now, here is a critical mindset shift. The returns alone mean nothing. A high return with extreme risk is not a good outcome because efficiency matters. How much return you get for the risk you take. Let's talk about losses because this is where long-term success is decided. Here's in the slide we can see clearly the large drawdowns, which is increased recovery time, which reduce compounding. So, controlling downside is more important than chasing upside. Avoiding large losses protects your future growth. And lastly, we had the dynamic strategy, which evolves throughout the time. Your income changes, your portfolio it should adjust. As your time horizon changes, your risk should change. As your financial situation evolves, your strategy must evolve too. And a static plan does not work in a dynamic life. Well, thank you for listening. And in this video, we can get the key points as a strong portfolio is not a random. It is structured, it is planned, and it is controlled. You define your constraints, you manage your risk, and you stay consistent.